Have you ever really wondered what separates the most successful traders from, well, everyone else? Today, we're diving into a masterclass that really pulls back the curtain on how that top 1% thinks and operates. But let's start with a pretty tough reality check.
All right, let's just get this out of the way. According to our source, a staggering 99% of people who try trading end up losing money. No, that's not a typo. 99%. It's a brutal number.
So that immediately leads us to the billion-dollar question, doesn't it? The one we're here to unpack. What in the world is that tiny 1% doing that the other 99% aren't?
To get to the bottom of it, we've got a roadmap. We're going to start with that hard truth, then look at how trading really works. After that, we'll get into the good stuff, how to read the market's secret language, find the real battlegrounds, and spot true market strength. And we'll wrap up with the single most important rule in the game.
Okay, so first things first, let's be absolutely clear. This is not a get-rich-quick scheme. Not even close. The speaker in our source material really hammers this home, even sharing that it took him six long years to get consistently profitable. This is a skill you have to earn. It's not a shortcut.
And here's the core idea. The reason the 99% fail is because they're all following the same easily available textbook advice that's floating around everywhere. The 1%? They succeed because they've learned to ignore all that noise and focus on how the market actually works behind the scenes.
All right, let's get into a really fundamental idea that sets the pros apart. You see, while most people only think about making money when prices go up, the top traders have figured out how to profit whether the market is soaring or totally crashing.
Just think about that for a second. A normal investor, right? They buy a stock and they hope it goes up. Pretty simple. But a trader plays a completely different game. They have tools that let them make money when the price is rising, and believe it or not, they can also make a killing when the price is falling.
So you're probably asking, how is that even possible? Well, the source gives this absolutely brilliant analogy with an iPhone. Picture this. You borrow a brand new iPhone from your friend. You promise to give them a new one back in a year. You then immediately sell that phone for today's high price, let's say $1,000. Now you wait. A year later, a new iPhone only costs $800. So you buy one for $800, give it back to your friend, as promised, and you just pocketed a cool $200 in profit. That right there is the basic idea behind short selling.
Okay, now we are getting to the real secret sauce. This is how the 1% learn to read a price chart in a way that most people will never, ever see.
You know, the source makes such a powerful point with this quote. I mean, if becoming a great trader was just about memorizing a bunch of chart patterns from a book, things like head and shoulders or bull flags, well then everybody would be rich, wouldn't they? But they're not.
And this is the fundamental difference. The 99% are trying to memorize patterns. The 1%, they learn to read the entire story, the entire battle that's happening inside of just a single candlestick on the chart.
They do this using a concept our source calls the imbalance of power. It's about learning to look past the simple color of the candle, whether it's green for up or red for down, and instead analyzing the real-time fight between the buyers and the sellers to see who is truly winning. So here's how you read it. Think of it like a battle. Those long, thin lines, the wicks, those are the footprints of a failed attack. The thick part, the body, that's the actual territory that was won or lost. So if you see a red candle, a down candle, but it has a really long wick sticking out of the bottom, that tells you a story. It says the sellers tried to push the price way down, but the buyers fought back hard and pushed it back up. Even though the candle is red, the buyers are showing incredible strength.
So now that we know how to read those little skirmishes, candle by candle, let's zoom out and find the major battlegrounds. These are the price levels where the really big players, the institutions, consistently leave their footprints.
You've seen this, right? You look at a chart and the price just seems to hit this invisible ceiling or floor at the exact same spot over and over again. Well, I can tell you it's not magic, and it is definitely not a coincidence.
What you're actually looking at are called support and resistance zones. But here's the key. The 1% don't see them as just lines on a chart. They see them for what they are. Zones where huge, unfilled orders from banks and hedge funds are just sitting there, waiting. They are literally the financial footprints of the market's biggest players.
Let me break it down. Imagine a giant bank wants to buy $100 million of something. They place the order, but they can only find $50 million worth of sellers at that price. So that first $50 million buy pushes the price up sharply. But their other $50 million buy order is still sitting back there, unfilled at that original price. So what happens when the price eventually drifts back down to that level? Bam! The rest of their order gets filled, and that huge rush of buying power sends the price shooting up all over again. And just like that, a support zone is born.
Okay, so we know where the big battles happen. But how do we know if a move is a real committed attack or if it's just a fake out designed to trap people? This is where the 1% are absolute masters.
And you can often see the difference just by looking. A strong, genuine move has these wide, powerful candles. It has momentum. It just screams that big money is behind it. A weak move, on the other hand, it just looks tired. Small, choppy little candles, no real momentum. That's a huge red flag that you might be looking at a trap.
And these traps are usually designed to hunt for one thing: liquidity. Now, in the world of the 1%, liquidity isn't some super complex financial term. It's much simpler. It's the giant pool of stop-loss orders from everyday traders that are all clustered together at those obvious support and resistance levels.
This leads to a classic move called a liquidity hunt. The big players will deliberately push the price just a little bit past a really obvious support level. What does that do? It triggers all those stop losses, which creates a massive flood of selling. And that flood of selling is exactly what they need to fill their own huge buy orders at a fantastic price right before they turn the market around and send it higher. They literally use the 99% as their own personal marketplace. We've covered a ton of ground here. We have learned how to read the market's hidden language and how to spot the footprints of the big money. But even with all of this incredible knowledge, there is one final piece of the puzzle, and it's arguably the most important rule of all. Look, understanding all this stuff gives you a powerful edge, a huge advantage. But, and this is a big but, it doesn't guarantee you'll win. It doesn't make you invincible, and this knowledge by itself is not enough to ensure you'll survive in the long run.
Which brings us to one final, absolutely critical question. You now have the tools to read what the market is trying to do, but knowing how to read the map is one thing. Actually navigating the dangerous journey is something else entirely. So, do you know how to survive it?